Hey everyone, and welcome back to another video, the first video of 2025. So let me start by saying Happy New Year. I hope we're all going to have an amazing 2025 filled with happiness, love, and lots of gains. Now, what better way to start 2025 than with a list video? In this case, we're going to start with 4 semiconductor stocks for 2025. Of course, we already spoke about Nvidia, Broadcom, AMD, and all of those, so those are not going to be on the list. Still amazing companies. In this video, I do want to touch on stocks that are maybe less sexy, let's call them. Talk about Lam Research, ASML, Micron, yes, Micron again, and of course the ugly duckling, my favorite, Intel. Yeah, I know some of you already turned off the video right now after hearing about Intel. Who's still talking about Intel in 2025? Well, yes, I think Intel at $20 and at current levels is quite attractive. I know 2025 is going to be a crucial year for the company, but I do think that 12 months from now, we're not going to see Intel at $20 anymore. So let's discuss all of that in this video. The next video will be about 4 fintech stocks. So if you're new here, hit that subscribe button. 2025 is the year where we're going to reach 100,000 subscribers. So if you're new here, do me a favor, hit that subscribe button. You can always unsubscribe later. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So we'll start off with Lam Research, ticker symbol LRCX. Now, Lam Research was underperforming last year. It was down 7%. Now, at one point, it was up close to 45%, but that's something that we've seen with plenty of semiconductor stocks. It has a market cap of $92.94 billion and has a forward PE of 20 times. And it pays a dividend with a dividend yield sitting at 1.27%. Now, if you look at what the analysts are expecting this company to do in fiscal 25, 26, and 27, you can see that EPS is expected to grow faster than sales. Looking at the current average analyst price target, that sits 28.5% higher than the price we're at today. And then looking at some pricing metrics, and despite the stock taking a hit, we can see that compared to the 5-year mean, forward PE, EV to EBITDA, price to sales, even price to free cash flow, but the first 3 are quite close to the 5-year mean. Price to free cash flow, that's in the last 12 months, that's a bit lower, but then price earnings to growth sits at 1.24. Now, since I am so generous these days, here you can see the comparison between Lam Research, Applied Material, and KLA. You get the forward PE, price earnings to growth, price to free cash flow, price to sales, and EV to EBITDA for all of those 3 companies. So if you want, you can pause the screen and look at those. So if we look at Lam Research, we've seen the year-over-year growth for revenue, but what about free cash flow? Well, in fiscal 25, free cash flow is expected to grow 16.2%, followed by, well, a flat-ish year in fiscal 26, but then another 15.2% year-over-year growth for fiscal 2027 to reach $5.64 billion. Looking at how they generate revenue, you've got systems revenue and customer support and other revenue, with system revenue being the biggest part of the two. Now here you can clearly see that back in 2022, that's when revenue peaked. Now the bottom might have been in already for quite a while here, June 2023, and since then the company has rebounded a little bit. Now we know that wafer fab equipment companies did take a hit because of the anticipation of lower spending in 2025, China risk, and all of that. But I do think that most of these stocks, if not all, have that already priced in. Plus, if you go back to the previous videos about Lam and Applied Materials, the earnings were not bad at all. Here you can clearly see the China risk, the concentration, right? Because if we look at where they generate revenue, China revenue is a big chunk of the overall revenue. Then you've got Korea, Taiwan, United States, Japan, Southeast Asia, and Europe. And with these types of companies, right, wafer fab equipment companies and other cyclical companies, it's always better to enter not when margins and earnings have peaked or are peaking. It's better when those things are suppressed or have been suppressed and now they're making their way back up, because you'd never know when the bottom will be in. So it's always good to look at those, see, oh, we have rebounded already, stock price does not reflect the quality of the business. I think now should be a good time to jump in. Moving on to company number 2, and that's ASML. And ASML is actually a copy of what we've just seen with Lam Research. Last year, stock was down 7.8%. At one point, it was up 45% during that year. ASML has a market cap of $276.3 billion and a forward PE of 29.1 times. The dividend yield sits at 0.82%. Now, ASML, yes, gets a premium because it's basically a monopoly. But even a monopoly can have some weakness. If you look at fiscal 2024, sales expected to be down 4.12% and EPS down closer to 10%. But then in fiscal 25 and 26, that's when we're seeing a rebound top and bottom lines. Although they expected a quarter and a half ago that 2025 demand will be higher than what they said to us last quarter. If we look at the average analyst price target, that sits 27.4% higher than the price we're at right now. Looking at some pricing metrics, we can see that from forward PE, EV to EBITDA, price to sales perspective, we are lower than the 5-year mean. Price to free cash flow, that's the last 12 months metric, we are higher at 92.9 times. Price earnings to growth came down quite a lot actually. We're now at 1.74. And here you can see why the price to free cash flow metric was higher. We can see that free cash flow in the last 12 months went down 48.5%. For fiscal 24, it's expected to be up 21.9% compared to fiscal 23. Then in fiscal 2025, that's expected to be up another 87.8%. And then in fiscal 2026, growing another 35.6%. Looking at where they generate their revenue, we can see that the majority of the revenue, of course, comes from net system sales and then the others from service and field option revenue. And of course, we've seen that net bookings did not pick up in the last couple of quarters. It actually peaked here back in the December 2023 quarter. But of course, as I've just said, it's, in my opinion, better to buy when we see these things, when things are low, than when things are peaking. And now if we look at where revenue gets generated, we can see here as well, just like with Lam Research, that China makes a big chunk of the revenue. Last quarter, that was 47%, and in Q2, that was 49%. But they do expect that the reliance on China will come down and will go back to the normal levels that they've seen a year or two ago. But as we are seeing more diversification across the globe, not just a concentration in Taiwan, I think ASML and Lam and Applied Materials and KLA and all of those will see some uptick in demand, especially in 2025. Might not happen in the first half, but in my opinion could happen in the second half of the year. Moving on to stock number 3, and that's a stock we've talked a little bit more recently, and that's Micron. Now, Micron plays a very important part in the semiconductor industry, not just because of the memory, but now, of course, because of high bandwidth memory, because of AI. Now, because of that, the stock is, well, funny enough, down because there is so much demand, but as you know, there are some supply chain issues, there are inventory adjustments because, as you know, they generate revenue through DRAM and NAND. DRAM doing quite well, NAND a little bit worse. So here as well, we can see that last year stock was basically flat to down, and at one point this stock was actually up 80%. Market cap right now sits at $93.7 billion and a forward PE of just 10.7 times. And here as well, you get a small dividend with a dividend yield of 0.55%. If you look at what the analysts are expecting this company to do in the coming fiscal years, in fiscal 25 and 26, huge growth top and bottom line, and then they expect the cycle to, well, turn into a down cycle already in fiscal 2027. I think that will be a bit early. If we currently look at the average analyst price target, that sits 56.5% higher than the price we're at today. Looking at some pricing metrics, forward PE, V to EBITDA, price to sales, lower than the 5-year mean. Price to free cash flow is, of course, last 12 months, that's much higher. And then price earnings to growth at just 0.29. And here you can see why price to free cash flow in the last 12 months is so high because, well, first of all, last 12 months is just $554 million. Then if we look at August 23, basically for the fiscal 23, that was negative. Then in 24, that's just 121. And in fiscal 25, that's expected to be up 2,647%, followed by another 103.3% growth in fiscal 26, and then a decrease in fiscal 27 by 24.4%. As I've said, they generate revenue through DRAM and NAND, and as you can see, DRAM is the majority of revenue, with NAND lagging. Now, if you look at, let's say, the cyclicality of the business, you might say, okay, this here, mid-2023, that was the bottom, and I think I can agree with that. And you might say that this right now might be the top. This is, by the way, next quarter, and next quarter guidance missed by basically $1 billion, now coming in at $7.93 billion instead of the expected $8.9 billion. But as you can see, the top of the so-called news cycle is going to be higher than the previous one. And that's because of HBM. And I don't even think that this will be the top. If we dive a little bit deeper, we can see that they generate revenue through compute and networking, mobile, storage, and embedded. And I think the recent drop in stock price, especially after the earnings report, presents a great opportunity for long-term investors. As I've said in previous video, I played the earnings trade. It failed, but I think I might re-enter for a longer-term position in Micron. I currently have no position, well, since the markets are closed right now, but I'll probably open a position later this week or the next one. Moving on to company number 4, and the last one, that's a company that I personally own. Yes, it's obviously now a bag holding company, and that's Intel. Intel, of course, was one of the worst performing stocks last year. It was down close to 60%. It now has a market cap of $86.48 billion and a forward PE of 28.7 times. Does not pay any dividend anymore, thank God. If we look at what the analysts are expecting this company to do, of course, sales in fiscal 24 is expected to be down close to 3%. Then in fiscal 25 and fiscal 26, sales is expected to grow 6 and 7.3%, and EPS to turn positive and accelerate in fiscal 2026 by 78.6% year-over-year growth. If we look at the current average analyst price target, that sits 21.3% higher than the price we're at today. And then looking at some pricing metrics, forward PE is higher than the 5-year mean. I'm not surprised. EV to EBITDA, price to sales, is lower. Price to free cash flow, well, there's no free cash flow, and there won't be any free cash flow in, well, the near future. Price earnings to growth sits at 1.14. If we look at what's expected for net income, usually I put here free cash flow, but like I said, the analysts don't expect this company to generate any free cash flow up until 2027 at least. So we have to look here at net income, and we can see that in 2025, fiscal 25, this company will generate $4.11 billion in net income, and then in fiscal 2026, that should increase by another 73.8% to $7.14 billion. Looking at the most important segments of the business, so total client computing, data center, network and edge revenue, and then you've got a little bit of Mobileye revenue here, but the focus is definitely on the first two, data center and AI revenue, and then the client computing group. We can see that the client computing group has held up, let's say, okay in the last year and a half. The data center and AI has seen a rebound in the last couple of quarters, but of course, with the hype around AI and data center, the real business around that, we are quite far away from where it should be. And as we've seen, AMD did surpass Intel for the first time when it comes to data center and AI revenue. Then looking at operating income per these groups, we can see that the client computing group is still quite profitable for them. So if you remove everything else, you look just at Intel products, it's still quite a good business to own. The problem, of course, is this pink bar right here, and that's the Intel Foundry part. This is the money-burning machine. Now, in 2025, they do expect the losses to be much better than what they are right now with all the restructuring, the one-time charges, and all of that. So that's why I think the overall profile of Intel will become much better in 2025. Plus, you're going to have quite easy year-over-year comparisons. But as I keep saying, with Intel, with AMD, if you want the stock to go up, you just have to release the best product for the market at, of course, the best price possible and the best performance. This is extremely important, especially for Intel. Of course, a lot of the focus in 2025 is going to be around 18A. If 18A can prove to be successful, I think the turnaround is on. So Overall, those are the 4 companies I wanted to touch on in this video. Of course, throughout the year, we're going to cover most of the semiconductor names. Leave your thoughts and comments down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one.